All right, let's dive into one of the most head-scratching earnings reports of the quarter, Caris Life Sciences, ticker CAI. You're going to want to see this because on paper, they absolutely knocked it out of the park. We're talking a Hall of Fame level quarter. But the market? The market told a totally different and frankly confusing story. So let's get into it. And this right here is the big mystery we need to solve. Imagine this. You beat earnings by something like 170%. You raise your guidance for the whole year. What happens to your stock? It goes up, right? Wrong. The stock got absolutely hammered, dropping almost 16%. So the question is, what on earth happened? What did Wall Street see that made them hit the sell button so hard? Okay, before we get into the why of the drop, we have to talk about the numbers themselves. And let me tell you, when we look at the facts of the quarter, Caris's performance wasn't just good, it was an absolute, undisputed blockbuster. So let's start with the top line, the revenue. It grew by more than 113% compared to last year, coming in at almost $217 million. Now that's already amazing, but here's the kicker. The analysts, they were expecting something like $174 million. Caris didn't just beat that number, they crushed it by over $42 million. That's not a beat, that's a mic drop. And if you thought the revenue was good, wait till you hear about the bottom line. It was even crazier. Wall Street was fully braced for another loss. They were thinking maybe 14 cents per share in the red. But nope, Caris comes out and delivers a profit of over $24 million. That's a 20-cent beat per share. The key takeaway here isn't just that they beat, it's that they flipped the switch from losing money to making money, a huge fundamental shift. So, how did they pull off that huge jump in profit? Well, it was all about efficiency. Check this out. Their gross margins, they just exploded. We're talking an improvement of over 2,400 basis points. Now, for those of us who don't speak Wall Street, that's 24 times full percentage points. They went from keeping about 44 cents of every dollar last year to keeping 68 cents this quarter. That is a massive sign of a business hitting its stride. So when you look at the scorecard for the quarter, it's just a sea of green, a clean sweep. Revenue, beat. Earnings per share, beat. EBITDA, beat. They even generated $55 million in positive free cash flow when they were burning cash before. I mean, you can't really ask for more. Across every single important metric, it was a flawless performance. All right, so how did they do it? What was the secret sauce this quarter? Well, when you listen to the earnings call, management really broke it down to a couple of key things that were firing on all cylinders. First off, the engine of this whole thing was their core business, molecular profiling. I mean, look at this. It made up almost all of the revenue, and it grew by a staggering 121%. The pharma R&D side did fine, but let's be real, the core diagnostics business was the absolute superstar here. And here it is, maybe the most important piece of the puzzle, the average selling price, or ASP. This is basically what Caris gets paid for each test they run. And it didn't just go up, it skyrocketed. It shot up 87% to over $4,000 per test. Now this is crucial. It wasn't just them jacking up prices. They got better at getting paid by insurance companies and sold a smarter mix of tests. In other words, this was high-quality, smart growth. And you could just hear the confidence in management's voice on the call. The CEO called it a significant milestone, and you got the sense he wasn't just talking about one good quarter. He was framing this as a turning point for the entire company, a shift towards real, sustainable, profitable growth. And that confidence, it flowed right into their guidance for the rest of the year. They didn't just say, we'll keep doing well. No, they raised the bar, and they raised it by a lot. So they bumped up their revenue forecast for the whole year, which now points to insane annual growth of 75 to 77%. They also said they expect to do more tests than they originally thought. And maybe most importantly, they told Wall Street to expect those awesome high 60s gross margins and positive free cash flow to stick around. The message was crystal clear. Folks, this is the new normal. Which, of course, brings us right back to that baffling paradox. You've got a perfect quarter, you've got a super bullish outlook, and what do you get for it? A brutal sell-off. It makes no sense on the surface, so let's try to make sense of it. What was going on in the market's head? This timeline of the stock price really tells the story of the chaos. So the earnings report comes out after the market closes on November 5th. And at first, everything looks normal. The stock jumps over 10% in after-hours trading. You'd think, okay, great. But then something happened overnight. The mood completely soured, and by the next day, it was a stampede for the exits. The stock just collapsed, ending the day deep in the red. And that's the core disconnect right there. The bull case, management's case, is all about the fundamentals. Look how well we're doing. It's simple and powerful. But the bear case, which clearly won the fight that day, wasn't really about the quarter. It was about everything else. The bears are asking, can they really keep getting paid this much per test? Isn't the stock already expensive? And what about all those insiders who are going to be able to sell their shares soon? It's a classic Wall Street battle. Amazing fundamentals versus fear and technicals. So you've got these two totally opposite stories playing out. Where do we come down on all this? Well, it's time for the next call, where we lay out our thesis for where Caris stock goes from here. Okay, so just to sum it up one more time. The bull thesis is this. It is incredibly rare to find a company growing this fast that is also profitable and spitting out cash. That's the holy grail. The bear thesis is all about the what-ifs. Valuation is too high, there are technical pressures on the stock, the whole sector is volatile. So the big question is, which side wins? Does the incredible fundamental story eventually overpower all that market noise?
For our part, we're kicking off our analysis with an outperform rating. And what that means is pretty simple. We expect this stock to do better than the overall market going forward.
So here it is. Our rating is outperform, and we're setting a price target of $38. Now look, we get the market's concerns. They're not crazy, but in our view, the story of profitable, super fast growth is just, it's too strong to ignore. We actually think this big sell-off is a mistake, and it's created a major disconnect between the company's performance and its stock price. It's a buying opportunity. So, how could you actually trade this idea? Well, here's one plausible path. Step 1, you could start building a position right around these current levels. Call it $25, taking advantage of what we see as an overreaction. Step 2, you're targeting a move back up into the mid to high 30s, right around our price target, as the market hopefully comes to its senses. And step 3, this is the big one, you watch that next earnings report like a hawk. If Caris proves this quarter wasn't a fluke, if they keep those margins and prices high, that's the catalyst that could prove the bears wrong and send this stock flying. And that's our take on the very strange story of Caris Life Sciences. It's a fascinating situation, but at the end of the day, we're betting that strong fundamentals will win out over short-term fear. Of course, please remember, this is not financial advice.